So you are a registered investment advisor, you use ETFs, and you're excited about the arrival of what we call active non-transparents. Explain to us, first of all, how you use active and passive ETFs in your portfolio. How do you mix them up?
We use both in our portfolios. We are big users as financial planners. We take a look at clients' goals and try to figure out an investment strategy that gets them to their place using the right kind of risk on it. And we use both the index and the active out there. And we like actives a lot, especially in certain areas such as fixed income, because we think there's where a lot of value can happen out there. But we use a lot of these usually in mutual funds, but one of the struggles we've had in the past is sometimes of capital gains that the mutual funds pass on. And with the ETF wrapper, you typically don't have that, and that's one of the reasons we're excited about it. The other reason is, in this no commission trade world these days on ETFs, it's kind of hard when you're purchasing mutual funds for $20 when you buy a similar ETF for $0.
Okay, so the cost is a big part of it. Let's talk specifically then about T. Rowe Price, which have released the pricing of their active non-transparents. Yep. What's the appeal here for the ETF version of these particular funds?
So we have used the T. Rowe Price funds in the past, and we like them because they have a good process, they have a good track record. They tell you they're going to do one thing and they actually do it. But the reason why we haven't used them overly these last few years is just because of the capital gains. I think last year some of their funds that are moving over paid between 2 to 7% in capital gains. And clients, most of our clients don't like paying taxes, so if we can avoid that using the ETF wrapper, we want to do that. Okay,
so tax consideration is certainly a big factor here, but the backdrop is that active equity funds, mutual funds, have seen 30 quarters of net outflows. It's pretty entrenched here. As these active firms launch ETFs of their funds, how critical does the track record really become? Because I would expect that a lot of underperforming active funds will also get turned into ETFs as well.
That's true. You're going to have the underperforming ones also turned into it. But what you kind of look at, like we look at it from a client's point of view as the risk that a fund is adding or taking into the portfolio. So not all funds are actually trying to shoot to beat the S&P 500. We want like an active equity income fund. If something's out there from T. Rowe pays like a 3.5%, but we also get the ability to get some growth on it. A person who's coming close to retirement would actually kind of like that in their portfolio.
So it just gives you more flexibility to match the product with someone's goals. All right, let's talk about direct indexing, because some have called it an ETF killer. You're pretty open-minded. It's something that you're willing to adopt as well. Explain, first of all, the difference between direct indexing and an ETF.
Yeah, so direct indexing is basically buying the underlying constituents of the index. So for the S&P 500, that can be buying portions of the S&P 500. You don't have to buy all 500 stocks. The math says about between 200 to 250 of those stocks will give you a close approximation to what the S&P can do.
Okay, so you said you can buy portions of the S&P 500. Once you start doing that, isn't that just a form of active, and you could underperform, as we've seen much of active equity funds do? And direct indexing, because it's more costly, and if you underperform, won't clients scream about that?
Yeah, you could. You definitely have to. You have to make sure that your tracking error is very close to what the S&P is. But one of the benefits that we get out of doing direct indexing is the tax loss harvesting. So now instead of having one asset, such as the SPY, now you have 200, 250 in my example. And last year, even though the market was up 29%, there was still 20% of the index that was actually down, which giving you some opportunity to take the tax loss on.
Okay, so you have more opportunity to harvest tax losses, but don't you run out of losses? I mean, the S&P 500 is up 30%.
Yeah, well, eventually you can, but that's down the road. If you use the SPY, you only have one chance of taking a tax loss. If you have 200 constituents, you can, have many more chances.
We were talking earlier about BlackRock going green. You use iShares ETFs a lot. What do you think about BlackRock's pledge to be more conscious about climate change and shifting its investment approach?
It's one of the questions that we get a lot from clients is about ESG. The problem that we've found with ESG is that one person's E is not another person's E. And we kind of use direct indexing sometimes for this, because like one person doesn't want fossil fuels, one person doesn't want guns. You can actually kind of do that in the direct indexing. But with the BlackRock coming out with more suite of the ESG, I've actually gotten a few phone calls today saying, hey, when are you going to put these into your portfolio? So it's definitely something that's on top of the mind for many investors.
Okay, so people are ready to dive in and take a look and see what these funds are actually made of then.
Yeah, and they got to realize that you might underperform the indexes there, and we need to make sure that people understand that. But if you take out fossil fuels and fossil fuels have a great year, you will underperform.